Let's discuss the most basic question. Can I actually afford a home? And I'm sure that if you're in the market trying to purchase a property, a home, your first home, in your back of your mind, you're thinking, is this the right thing to do? Can I actually afford it? What should I be looking for? Where am I going to fail in this transaction? And I think that's a very fair statement. My name is Zevi and I'm an owner of a company called Brook. We're a wholesale mortgage company in Los Angeles, and I want to discuss that with you. I also want to discuss a couple other things, specifically how much of a mortgage payment and how the payment is determined. And I also want to touch on some credit things. So with that, let's dive into this video, all right? Now, I want to tell you a story. There was a guy that I want to say for the past 5 years, every single time we've spoke, has asked me, hey, Zevi, should I buy a property? Should I buy a home? Is now a good time to buy a house? And ironically, if you think about it, over the past 5 years has been a great time to purchase a property. And ironically, when you zoom out, whatever, 5, 10, 20, 30, 50, 100 years, has it ever been a bad time to purchase a property? Specifically, if you're talking about something that you're going to be living in. And let me break this down for you, simply because if you know that properties appreciate in value, and it doesn't really matter where you live, over time, I think it's fair to say the properties appreciate in value. Now, for us here in Los Angeles, it's about 5% a year, and I think nationally is about the same. However, there's been years where properties appreciated a lot more. And the nice thing about owning real estate is not only the fact that you own it, is the fact that, think about this, even if you come in with a small down payment, you leverage a much bigger asset. Let me give you an example. Say you're buying something for, I'm just gonna say $500,000, okay? And let's say you're putting down 5%, that's $25,000. So you're holding on to an asset that's worth $500,000 with 25%, 5% down, right? So if over the next year, the property appreciates 5%, you basically put your down payment back in your pocket, which is pretty crazy. So if you've done nothing else in terms of investments, if you just bought yourself a primary residence, more than likely over an extended period of time, that would be your greatest investment, your greatest asset. Now, you might ask yourself, okay, fair enough, but how do I know that I actually qualify for this property? I mean, I don't want to have an issue, whereas if I rent something, tomorrow I can walk away from the property and I don't need to worry about anything. It's very true. So let's analyze that a little bit. Typically from a lending perspective, and this is just speaking from experience, when you underwrite a file, you typically underwrite to anywhere between 40 to 45%. You can underwrite to 50%. Now, what does that mean? You have a job. Your job pays you, let's just use an example of $5,000 a month. You don't want to exhaust more than 50% of your income at max. Now, you typically want to be between 40 to 45, but let's just use 50 because it's doable to have all your expenses fall into that bucket of 50%. That's what the lender is going to be looking for. So let's just say you're making $5,000 a month gross. Your expenses, including your car and including your mortgage, which also includes your property taxes and insurance, and HOA if you have that, shouldn't surpass more than 50% at max of your gross income. So if you're trying to figure out, okay, well, how would I know that? So if you go into my site, my company site, it's called loanbrook.com, LOANBROOK, also in the description below. You can log in, and on the top, there are tabs, and one of them is calculators. Using a mortgage calculator would actually show you the amount of payment that the property would be. Now, mind you, in today's, frame of rates, we are hovering around 7%. So no matter what the loan amount is, if you just, for conversational purposes, plug in 7% to the loan balance that you're trying to finance, then you can get an idea of what the loan amount would be. In addition to that, don't forget property taxes in Los Angeles, they're 1.25%, and insurance is typically calculated at 0.3% of the loan amount. Take that number, divide it by 12, and then that's your monthly insurance. If you have homeowner insurance, put it in, HOA, all right, homeowner association, put it in there. If it's a condo, right, it's an extra payment. In addition to it, your car payments, etc., anything that is revolving or installment, meaning I'm going to see it on your credit report, which is, ironically, what I want to talk about next. So hopefully you understood that piece. Cannot be more than 50%. However, if you have a question about it and you're not sure how to go about it, not a problem. My number is 818-697-8220. Feel free to give me a call. No pressure. I'll be happy to walk you through that question. Or if you want to ask it, just drop it in the comments below. And again, I'll give you the answer to it. Let's move on to the credit piece. I guess right before we move on to the credit piece, I do want to mention to you that if you're a higher earner, you do have the opportunity to finance something for a shorter period of time. And the only reason I bring that up before we shift gears here is because everyone is gung-ho about the 30-year mortgage. Everyone's super happy, I want a 30-year mortgage. But what you don't know, or you might know, is that over a 30-year period, if I borrowed $500,000, I'm basically paying back the lender $500,000, whomever that may be. It's just the best investment possible for a lender or a bank. Okay, not myself an originator. I'm not actually writing the check for your property. But for the bank themselves, or Fannie Mae, whoever's giving you the money to do this deal, think about it. A 30-year mortgage, you borrow $500, you pay back $500. That's an incredible opportunity for them as long as you're not defaulting on your mortgage, all right? And a lot of the interest is actually paid in the front. That's why it's an amortized loan. We could talk about that on a different video. But if you do have the opportunity to pay more upfront, then I would actually, talking about my mortgage and how it's determined, I would say, let's talk about a shorter term of a mortgage, because the shorter the term, the lesser the interest rate, the less interest you pay the lender. Also, if you are in a 30-year mortgage, throw another payment in there once a year if you can, and you'll significantly cut back on the interest of your loan. You may cut back 5, 6, 7 years with just throwing an extra payment in there. So every single year, all right? That's a great shortcut. Anyways, so we're shifting gears. Let's talk about the credit piece. It's important to know a couple things. When you're going into a purchase transaction, credit plays a very big role in the transaction. In addition to credit, of course, there's other factors, such as if you have a high loan to value, meaning that if you're financing 97% of the balance versus say 80% of the balance, clearly you're going to get a better interest rate when you put a larger down payment. In addition to it, which I definitely wanted to mention to you, if you put less than 20%, then you're going to also have something called mortgage insurance. You got to factor that in at about 0.5% annually. It could be less than that, but let's just say, to be conservative, 0.5% annually, which is a part of your liabilities, not to exceed that 50% that we've discussed. Okay, so coming into the mortgage transaction, what are we looking for on the credit side? You got to have some credit established. Exactly what? That's determined by the electronic engine of either Fannie Mae or Freddie Mac. It spits out something called a DU or an LP approval, which basically means that subject to the information you've provided to either Fannie or Freddie Mac, because it runs through the system of the lender, and then depending on which direction you go, each one of them has just slightly different guidelines, okay? So it tells you what the requirements are. And typically speaking, you still need to have a minimum credit score of 620 to qualify, all right? That's really important. Now, how much credit do you have to have in place? Well, typically, 2 trade lines for about a period of 2 years. And that actually falls true for people who have a new Social Security number. I don't know what the actual guideline would be from Fannie and Freddie Mac. I could just look it up because all those guidelines are national guidelines. But there are guidelines, and there's also something called overlays, meaning that depending on who you get your loan through, they might want to make sure that you have certain things in place before they're willing to fund the deal. These things are very important to know, especially if you don't have a lot of credit. So it's something that you definitely have to discuss upfront with your lender. I also want to discuss things that happen to us all the time, like credit freezes. Somebody freezes their credit, we run their credit, guess what? I can't pull in the credit scores. I got to get in touch with the credit bureau and request that they pull in these credit scores only after you unfreeze your credit. In addition to it, what happens if you've had derogatory credit, like a bankruptcy or a deed in lieu or a loan modification? There's waiting periods for some of these things. Some things like a bankruptcy could be a 7-year wait. A deed in lieu or a short sale could be a 4-year wait. I guess it depends on whether you're trying to get a jumbo loan or a conventional loan. Again, these loans are just sold off to different investors. I think the best way to do this is if you are looking to get involved in buying and you do need to get pre-qualified or pre-approved, then the best thing to do would be to reach out to a reputable loan officer or loan broker like myself. Go through these steps, go through these motions, because the thing is, the more homework you do up front, the easier it becomes on the back end, because ultimately I take my work and I provide it to the underwriter. And I'm not looking for them to give me a ton of conditions. I want to make sure that I've already bypassed a lot of the things that I know are going to come up in the transaction, so we don't have to deal with them later. All right. So if you have any questions, again, I encourage you, drop them in the comments below. My number, again, 818-697-8220. I look forward to speaking with you. If you like this video, I would highly appreciate if you hit the like button, simply because it will make it easier for other people like yourself who are looking for this kind of information to find it. And in addition to it, if you want to see more videos like this in the future, then I would highly encourage you to subscribe to my channel. All right. Otherwise, thank you so much for watching this, and I look forward to seeing you again on the next video. Take care.